Silver got shellacked. I mean, it was down like 10 bucks. Silver has been very, very volatile recently. But as I'm talking, it's still about $82.70. So even though it's been very volatile, it's still miles above the old $50 breakout. I don't think gold traded below 5,000 today because the war needs to be paid for, which means bigger deficits. This means more Fed money printing, more inflation, and the war will be disruptive. It's already disruptive in the oil market. It's already disrupting shipments in the Straits of Hormuz, which are basically closed now because Iran says it's going to sink any ship that tries to cross. Since everybody knew that war was coming in some form, we were going to do something, I think that a lot of traders bought gold thinking, okay, we're going to attack Iran. That's going to be good for gold. It's going to be disruptive to the economy, the markets. I'm buying gold. I'm buying silver. How long were we in Iraq? How long were we in Afghanistan? Gold, which closed last week on Friday at about 5,250. Gold rallied above 5,400 initially, but it really couldn't make a new high. It didn't get above 5,500. Silver rallied, but I don't know if it got to about $95, $96 an ounce, nowhere near the highs. And then silver went negative on yesterday, and gold, lost more than half of its gains, and the stock market recovered. It was barely down. Now, today there was a bit of a delayed reaction. At one point, the Dow was down 1,200 points, but it closed down less than half that. And, it's down a little bit tonight, rather. I'm talking the Dow's off. Dow futures off about 150 points. But the Dow is still above 48,000. Not that much below 50,000. The stock market has really not priced anything bad in. It's still priced for near perfection. The market is extremely overvalued. So the war is not going to be good for the market. And, even if oil prices go up a lot, we're not going to be able to have a meaningful increase in domestic output. The oil industry is not going to be able to ramp up capacity that quickly, and they're not going to do it unless they believe that the oil prices are going to stay high.
The market barely blinked even as gold whipsawed hundreds of dollars in a single trading window. As Peter Schiff points out here, gold surged toward $5,400 but failed to break $5,500, while the Dow shrugged off a 1,200-point drop and still sits above $48,000, a sign that equities remain priced for near-perfect conditions. That disconnect matters because historically, geopolitical shocks push investors towards safety first and equities second. If oil spikes while US production stays constrained, margins across transportation, manufacturing, and retail compress quickly. Investors should watch energy and inflation expectations carefully here. Next, Peter Schiff discusses why oil producers may not respond the way markets assume.
If they believe it's just a short-term spike, they're not going to invest the money so that by the time the oil comes to market, the price has gone down and now they're losing money on every barrel because we're a relatively high-cost producer. We're already producing the low-cost crude. Anything that we can produce cheap, we're already producing. So if we have to get the more expensive oil, we're not going to do that unless the price is not only higher, but the oil companies have to believe that it's going to stay higher. So it might take a while for that to sink in if everybody thinks this is all just about the war and it's going to be over quickly. So we're going to be looking at much higher prices. Gold prices, after not going up very much yesterday, got killed today. Gold at one point was down, it was down over $300 or $250. But the interesting thing was it really held 5,000. I don't think gold traded below 5,000 today. Got close, but it didn't get below. And as I'm talking now, it's back at about 5,150. Silver got shellacked. It was down like 10 bucks. Silver has been very, very volatile recently. But as I'm talking, it's still about $82.70. So even though it's been very volatile, it's still miles above the old $50 breakout. Now, a lot of gold and silver stocks got killed today.
Oil supply doesn't surge overnight just because prices spike on a headline. As Peter Schiff points out here, the US is already producing most of its lowest cost crude, meaning companies will only invest in new drilling if they believe higher prices will last long enough to justify billions in capital spending. That lag matters because gold briefly dropped more than $250, yet still held the psychologically critical $5,000 level, a signal that underlying demand remains strong despite volatility. Silver's plunge toward 82 $82 looks dramatic, but it still sits far above its old $50 breakout zone. Next, Peter Schiff talks about why mining stocks collapsed even while metals remain historically elevated.
They were down 10%, 12%, 15%. They cut those losses basically in half, but they shouldn't even be going down because $5,000 gold and $80 silver are prices in which these companies are massively profitable. And the profits are much higher than what anybody expected they were going to be a year or two ago. Yes, the prices are up, but they're not up nearly as much as they should, given the impact that these higher prices have had on their earnings and their earnings outlook. But the reason I think that you had this sell-off today and partially yesterday is just a classic buy the rumor, sell the fact. It was pretty obvious to everybody, which is why there was no reason not to have a vote in Congress. The whole world knew, including the Iranians. So there was no need, to worry about spilling the beans by debating a war in Congress. The reason that Trump didn't go to Congress is he was pretty sure that Congress would not vote for this war. So he had to just wage it on his own. But since everybody knew that war was coming in some form, we were going to do something, I think that a lot of traders bought gold, thinking, okay, we're going to attack Iran. That's going to be good for gold.
Sometimes the market sells the news even when the fundamentals improve. As Peter Schiff points out here, mining stocks dropped as much as 10 to 15% despite gold near $5,000 and silver around $80. Price levels that dramatically boost mining profit margins compared to just 2 years ago. That kind of disconnect often reflects short-term trading flows rather than long-term valuation, especially when investors front-run geopolitical events and then lock in profits. Institutional funds frequently rotate out after the headline hits, even if the macro trend hasn't changed. For long-term investors, those moments can signal opportunity rather than danger. Next, Peter Schiff unravels how traders positioned ahead of the Iran escalation.
It's going to be disruptive to the economy, the markets. I'm buying gold. I'm buying silver. So people got bought in anticipation of this event. And then when the news came, they sold, right? Gold couldn't make a new high above 5,500. And so the people who bought it at 4,900, 5,000, 5,100 took profits. Classic. And that's why the markets went down. Gold stocks, even more volatile. Maybe some people thought that the price of gold would go up if we attacked Iran. And so they decided to buy gold stocks. And when we did attack Iran, they sold those gold stocks. This is what traders do. But the reality is investors could ignore the noise and, if anything, just take advantage of the opportunity that the traders are creating, because the war is bullish for gold. It's bullish for gold not just because it's bearish for the economy, but because it's inflationary. Why is it inflationary? Because politicians always pay for wars through inflation. The last thing they want to do is make a war even more unpopular by asking the public to pay for it. Right? The politicians are not going to say, we're fighting this war and wars are expensive, and so we have to raise your taxes so we can keep supplying the troops. Right?
The real driver behind gold isn't the war headline. It's how governments pay for the war afterward. As Peter Schiff points out here, Traders piled into gold before the Iran escalation, expecting a breakout above $5,500, only to dump positions once the event actually occurred. That buy the rumor, sell the fact dynamic shows how short-term speculation often distorts price action even when the underlying macro story strengthens. Historically, major conflicts expand deficits and accelerate money creation rather than tax hikes. For investors, that means inflation risk tends to rise long after the first market shock fades. Next, Peter Schiff discusses how governments historically financed wars.
People don't want that. In fact, you remember when Bush went to war, not only did we not raise taxes, we cut taxes. And in fact, and this is George W. Bush. And in fact, what George Bush said is, we're going to war, but you got to make sure you don't stop shopping. We don't want to let the Iraqis know that this war is interrupting our shopping spree. So go out and buy stuff, right? Really show those Iraqis what we're made of. Whip out that charge card. Go to the mall. Spend, right? The opposite. When we went to World War II, what did FDR tell the American public to do? Stop spending money. Save your money. Buy war bonds, right? Not only did we raise taxes to fight the Second World War, and we raised them massively, huge tax increase. I mentioned this before. The withholding tax was introduced as the victory tax. Before World War II, nobody had income taxes taken out of their pay. It was only because of World War II that the government started taking taxes out of people's pay. And most of the people who paid income taxes during the war paid no income taxes before the war.
War financing has changed dramatically, and investors rarely think about what that shift means. As Peter Schiff points out here, during World War II, Americans faced massive tax hikes and were urged to buy war bonds, while during the Iraq War, the message was the exact opposite. Keep spending and don't interrupt consumption. That policy shift matters because modern wars are often funded through deficits and central bank liquidity rather than direct taxation. The result is hidden inflation that spreads slowly through housing, energy, and everyday goods instead of appearing as a clear war tax. Next, Peter Schiff discusses the long-term economic cost of financing wars this way.
For average Americans, the income tax was introduced to pay for World War II. But not only were Americans commanded to pay higher taxes for World War II, then the government said, you know what? The money that we didn't take from you in taxes, please loan it to us by buying our war bonds. Right? You gotta loan us money because the taxes aren't enough to pay for the war. You got to lend us money too. So Americans paid higher taxes and they bought war bonds. So what did they stop doing? They stopped spending. They didn't go out and buy stuff. They didn't eat in restaurants. They didn't buy stuff in stores. They stayed home. In fact, the women went and got jobs. Right? They Rosie the Riveter. They went to work in the factories because their husbands who worked in the factories were in Europe. They were in Japan. They were soldiers. So the women had to work. They had to give up, their lives as housewives and go to a factory. So the whole country sacrificed to pay for World War II.
The biggest difference between past wars and modern wars isn't strategy. It's who actually pays the bill. As Peter Schiff points out here, during World War II, Americans faced higher taxes, bought war bonds, and dramatically cut consumption to finance the conflict. That forced discipline slowed spending, but created a clear national accounting of the war's cost. Today, the mechanism is almost invisible because deficits and central bank liquidity replace direct sacrifice. Investors should recognize that when spending isn't reduced during wartime, inflation quietly becomes the hidden tax. Next, Peter Schiff discusses why modern wars feel free even though their economic cost is enormous.
No American has been sacrificed to pay for any of these wars. We've been told to just keep on spending, keep on borrowing. The wars are free. That's one of the reasons we're able to fight all these wars, is because nobody thinks they cost anything. They cost a fortune. We're talking now about the cost of living, the affordability crisis. The reason that things are so unaffordable is because the government spent so much money. And part of what the government spent money on were wars. And we're paying for all these wars through higher prices. Every time you buy something that's more expensive, the reason it's more expensive is because you're also paying for the cost of government. It's embedded in the price of everything that we buy. And this war is going to mean that everything we buy is going to be that much more expensive because we're going to have to pay for the war. But anyway, so the war is bullish for gold. So ignore this pullback. You want to buy the dip in gold, buy the dip in silver. Obviously, you can go to Schiff Gold and do that.
The affordability crisis didn't appear out of thin air. It accumulated through years of hidden fiscal expansion. As Peter Schiff points out here, modern wars are financed through borrowing and monetary expansion rather than immediate taxation, which pushes the cost quietly into consumer prices. That's why groceries, housing, and insurance premiums have surged over the past decade, while official explanations often blame supply chains or temporary disruptions. For investors, this means inflation isn't just cyclical, it's structural when governments fund policy through deficits. Hard assets tend to respond earlier than policymakers admit. Next, Peter Schiff shows why gold and silver often react before inflation fully appears in official data.
The mining stocks, again, sold off. A great opportunity to buy more mining stocks. Emerging markets also have gone down because the dollar's gone up the last couple of days. Dollar index is now back around 99. But I don't think this is going to be the start of a new bull market in the dollar. We were de-dollarizing before the war, and the world is going to continue to de-dollarize during and after the war. In fact, there's a chance that this war could diminish America's status in the world if it isn't over quickly. If the Iranians manage to hang in there and this thing drags out, I think that diminishes the power that we project. So we've got a lot to lose, not necessarily a lot to gain. But I would be buying the pullback in foreign stocks. This is an opportunity. Iran should have been less of a threat than it was before. Yet all of a sudden we had to go to war, right? We need to have regime change. Who cares what the next regime is? We just got to get rid of the one we got now and just take our chances on whatever comes next. So
a rising dollar during geopolitical stress can look like strength when it's often just temporary capital flight. As Peter Schiff points out here, the dollar index bouncing back near 99 doesn't necessarily signal a new bull market if the broader global trend toward de-dollarization continues. Over the past few years, central banks from Asia to the Middle East have steadily increased gold reserves while reducing dollar exposure, a trend that rarely reverses quickly. If the conflict drags on, geopolitical credibility can shift along with capital flows. Investors should watch emerging markets carefully during these pullbacks. Next, Peter Schiff discusses why prolonged conflicts can weaken global confidence in US leadership.
So Trump's going to have a lot of problems. The economy is going to get worse. Remember, it was going to get worse anyway. Inflation was going to get higher anyway. That's going to happen. But the war is going to make all those things worse because the war needs to be paid for, which means bigger deficits, which means more Fed money printing, more inflation, and the war will be disruptive. It's already disruptive in the oil market. It's already disrupting shipments in the Straits of Hormuz, which are basically closed now because Iran says it's going to sink any ship that tries to cross. So the ships obviously don't want to go through. The insurance companies are like, look, we're canceling your insurance. You go through, and you sink, don't put in a claim. Now, earlier today, Donald Trump came out and said the U.S. government is going to now insure all these ships, which seems like a very dangerous thing to do because if we know the ships are going to get sunk, what's the point of insuring them, right?
The real economic shock from war rarely begins on the battlefield. It starts in supply chains. As Peter Schiff points out here, disruptions around the Strait of Hormuz threaten a corridor responsible for roughly 20% of global oil shipments, making energy markets extremely sensitive to even small blockages. If insurers refuse coverage and governments step in to guarantee risk, taxpayers quietly inherit the liability for damaged cargo and destroyed vessels. That kind of policy shifts private market risk onto public balance sheets, expanding deficits almost immediately. Energy costs, freight rates, and insurance premiums could ripple through the entire economy. Next, Peter Schiff unravels the risky policy of government-backed shipping insurance.
I mean, and I don't know why the captains would even want to, maneuver the ships through, because maybe they're going to have autopilot, so the ships can go through without any human beings, and then any of them that get sunk, the United States just has to write a check, and we have to cover that. It seems like an asinine policy to me. Although Trump also said that maybe we're going to have a naval escort and we're going to escort each ship. But I don't know. I mean, I don't know if that's going to protect the ships if they're an easy target. But oil prices are higher, obviously, and they're going to stay higher throughout the length of this conflict. Now, the president says it'll be a week, it'll be 2 weeks, it'll be 4 weeks. Look, I remember when the Russia-Ukraine war started years and years ago. It was supposed to be over quickly.
Markets often believe the short war narrative, even though history almost never supports it. As Peter Schiff points out here, policymakers are already discussing naval escorts and government-backed insurance to keep tankers moving, a sign that officials expect prolonged disruption despite public optimism. The energy market tends to price risk faster than politicians admit, which is why crude prices typically rise weeks before official policy shifts. If oil stays elevated through the next Federal Reserve meetings, inflation expectations could quickly reset across transportation and manufacturing sectors. Investors should watch how long energy premiums persist. Next, Peter Schiff discusses why quick wars rarely remain quick in reality.
Yeah, there's no end in sight for that. How long were we in Iraq? How long were we in Afghanistan? All these places that are supposed to be quick in and out, it never happens. The definition of insanity is doing the same thing over and expecting a different result. Why should we expect a different result with Iran? I don't. I mean, I can hope we get a different result, but I'm not going to expect it. And also, I know we're not being told the truth. Trump is not being honest about why this war was started. And once you catch him in a lie, I mean, who knows how many other things they're lying about. And Trump lies about so many other things. Why would he be honest about this? So all this is bad. Anyway, the market reaction so far has been very muted. The Dow and S&P was barely down on Monday, right? Started Sunday night because the war started on Saturday when all the markets were closed. The only market open was Bitcoin, which originally sold off down to about 63,000. But then it bounced back and the stock market barely went down.
One of the quietest warning signs in markets is when investors ignore geopolitical risk entirely. As Peter Schiff points out here, despite the outbreak of conflict, the Dow and S&P barely reacted while Bitcoin briefly dipped towards $63,000 before rebounding. That muted response suggests traders still believe economic disruption will remain contained, even though past conflicts like Iraq and Afghanistan stretched far longer than originally promised. Markets often underestimate duration risk because long wars unfold gradually rather than in one dramatic shock. For portfolio strategy, that means watching energy, defense spending, and inflation expectations closely.